You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.
You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, your Options Bootcamp drill instructors, Mark Longo and Dan Passarelli, will break it all down for you.
Old trading walks into a bar. New trading raises it. That's Tasty Trade. Keep focused with news feeds that matter. See opportunity differently in analysis mode. Chart your heart out with over 300 indicators. Plus, you can get low pricing, lots of education, and a support team that really gets how traders trade. It's no wonder Investopedia named Tasty Trade the best broker for options in 2024. Genius loves company. Go to tastytrade.com/podcasts and see for yourself. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Fall in boot. It's time to get into peak options trading shape. It's time for Options Bootcamp.
All right, everybody, that music means we are back once again. It is Education Wednesday. One of my favorite days here on the network because we get to hold court on everyone's favorite options educational program. Yes, it is time once again for the old OBC. My name, of course, Mark Longo from theoptionsinsider.com. Reminding you, A, make sure you subscribe to the full network. Otherwise, man, you are missing out. And B, speaking of missing out, if you're not hanging out in the pro, you are missing out on an extravaganza of content. Strap in if you're hanging out in the pro today. You got not one, not two, not three, not four, but 5 shows coming at you back to back to back. Man, my poor voice. So you got a lot of great stuff coming at you. Strap in, grab some popcorn, fire up your trading screen. Should be a fun time. If you want to join the pro, theoptionsinsider.com/pro. PRO is the place to go to learn more about how to get past the velvet rope. You get the live streams, you get the pro Q&As, you get Options Oddities, which is the unofficial, but now really official after party of volatility views. And then, of course, you get fun stuff like the Fantasy Cast, which has been popping up there of late, which has been really fun. And then, of course, the final Pro Trading Crate giveaway of 2025. You want to get your name in the hat for that, if for no other reason than to thumb your nose at the Rock Lobster on social media. It's a good time. TheOptionsInsider.com/pro is the place to go. As I am pleased, we had fun last week slumming it with some options guy on the old show. But now we're back to business. The black-hatted one is joining us once again, a.k.a. Daniel Mojito Passarelli III, Esquire. Mr. Mojito, welcome back to the show. So are you a fan of a good mojito?
Yes, if made properly, I am, as a matter of fact. None of that like pre-made canned baloney, but
I think if made properly is the key there. Sometimes you get them and it's all just like seltzer, and you're like, this is terrible, or the mint is overwhelming. You got to have a good mix, a good blend. You're right, sir.
Indeed.
I hear you're quite the hand at a mojito. I meant to come down there and to the options mecca and try my hand at a Passarelli. They don't call you mojito for nothing, sir.
Yeah, I would say my old-fashioned skills are a little better than my mojitos.
Interesting.
Yeah,
maybe I'll have to be the judge of that. I will compare and contrast. Tell you what, we'll meet at that truck stop behind your house / movie theater, and we'll be drinking old fashions and mojitos, and then the cops will pull up like, "What are you guys doing?" It'll be a good time. We'll be had by all listeners. Speaking of a good time, it's time to commence the good time, a quintuple extravaganza on the network today. It is time for a little bit of options drills. Fall in boot.
Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
One of the reasons I love doing this show, Dan, because even in the depths of the polar vortex, which we've been feeling around here in Chi-Town of late, we get this festive summertime Flag Day, July 4th kind of music here on the show. So it always makes me feel like we're in a summertime state of mind here on the show. But we're going out to options drills, of course, the portion of the show where we break down an options concept or technique or strategy, tell you some tips or tricks, how the pros tend to utilize it, how you maybe can utilize them in some more advanced or perhaps different ways in your portfolio. And Dan, today's topic was actually inspired by, I'm not sure if it was a question or really just kind of a cry for help to the universe. But this question came in from Misk. So just miscellaneous, just Misk, unless it's Miss C, but there's no period or anything there. So I'm going to go with Misk. And they just wrote in, Dan, to say, is it still the wheel if you haven't sold a call in 3 months because you're waiting to get back to break even? And that just made me laugh, not for their pain, but because we've all been there, Dan. We've all been there. I may be in one or two of those myself right now. So we're all feeling the pain, and that just brought a smile to my face, Dan. So first off, I guess we have to answer that for Misk. Is it still the wheel, sir, if you haven't sold the call in 3 months and you're just waiting?
I don't know about that. I'm thinking no. And if you want to get back to, if you would have sold calls for the past 3 months, you might be back to even already.
Well, that is a good suggestion, sir. It kind of fits right in with our topic, Dan, which is, we all love the wheel. We talk about the wheel here a lot on the network. I've said if I had to only do one trade, it probably would be the wheel. But what do you do, Dan? What do you do when the wheel goes bad? When the wheel takes a bad turn? And when you're kind of just riding and you're like, oh, I don't know if I'm still in the wheel or not. So that's what we're going to talk about today, Mr. Dan. What to do when the wheel turns against you. So obviously the wheel, listener, you talked about it a million times. We don't need to belabor what it is again. You're selling puts to get into an underlying, selling calls to get out. There's a million different ways to carve up the wheel. Check out Dan's book coming soon if you want a deep dive into all things wheeling. But the most common bad, I would say, scenario in this, Dan, is you come in, you sell a put to get into the wheel, to kick off the wheel. Let's say you sell XYZ put on the 20 strike, and then you have the stock put to you at 20, like you wanted, and then the stock takes a turn, takes a nosedive, falls to 15 or, God forbid, 10, sir. And now you're saying, what the heck do I do? Would you agree with that, Dan? Is that the most common, let's say, bad scenario in the wheel trades?
Saying, what the heck do I do now? That's always a bad scenario when it comes to trading.
That is always a bad scenario. And also when you get the stock put to you and it just falls out of bed. Never a good feeling, Mr. P. All right.
I don't know.
Oh, you like it?
Sometimes I like it. I was just talking about this with somebody earlier today. I feel like the wheel is one of the most misunderstood strategies of all. Oh my gosh, I don't know. You know what? I'm about to go down a rabbit hole. Maybe I should just follow your lead here.
Let's follow a guided rabbit hole. How about that? Let's do that. Let's start, and then we will unleash Dan. One of the reasons I wanted to do an episode on this is because I thought you would probably have some thoughts. So what was the old Jack Handy? Deep thoughts, right? That's deep thoughts with Dan P. All right. There's a bunch of different ways this can play out. Listen, let's just workshop the most common one. Sell put at 20, stock gets put to you, stock drops, let's say, to 15. Scenario one. Hey, you did your due diligence at the onset. Something we've preached from the beginning here on this show, all the way back in the primordial ooze days. When you're selling puts, whether it's to commence the wheel or not, make sure first you're comfortable with that level in the stock. If you're not, then perhaps you need to choose a different level or perhaps reconsider the strategy altogether. So if you liked it at that level, as long as your analysis, as long as nothing has really changed, you know, if the fundamentals of the stock, technicals, whatever got you into the trade to begin with are still the same, then you should have been comfortable with that level to begin with. So scenario one, Dan, is you just keep the stock. It might get you in a situation like, what was our listener, Misk, where you're sitting on it for a little bit. That could be one alternative, Dan. What do you think to that? You sell the put, the stock goes against you, and you decide, you know what? At least for right now, I'm not really riding the wheel. I'm more of a stock investor, sir. What say you to that?
All right, Mark, I can't help myself. I got to do a little bit of a preamble here to my answer. Is that cool?
Go ahead. Cool? Preamble away.
All right. So so this is probably the main premise of my upcoming book. So every wheel trade must start with knowing your objective. Is your objective to skate on that put and just keep the premium and move on? Or is your objective to get assigned? The one thing that I hate, like when I was taught how to teach options, because somebody taught me how to teach options, you know, the thing that you see all the time is people saying, so yeah, you sell the put if you're okay buying the stock at that price. But that is such bull crap. It's, I don't want to, or I do want to. Do you want to get assigned or don't you want to? So if you had the objective to trade into the stock, then we couldn't even call this a bad scenario. It's exactly what you wanted to have happen. If you wanted to skate on the put, just sell it and keep the premium and move on, then why'd you allow yourself to get assigned? I mean, don't get me wrong. You can get assigned early and lots of things can happen, but what was your plan to deal with it if you were starting to get likely to get assigned? So I don't know. I mean, I guess that's a different lens to look at all this, but that's where I live.
Yeah, quite frequently there's a difference between saying you're going to do the wheel and then really just selling puts with hope, right? Yeah. A lot of people say they're doing the wheel, but in reality, they're kind of selling puts with hope. And so you have to make sure you draw that distinction, that delineation in your own mind. Are you really just selling puts with a little bit of hope, or are you down with the wheel? So now you got this stock, listeners, and it's going against you a little bit. But as we kind of just laid out, if you were okay with that level, if the stock was 25 when you sold that put and now it's below 20 and you got to put to you and it keeps going down, well, you got a much better level than, let's say, 25 in that scenario. So you have a couple of things you can do. Dan, the first most obvious thing, probably the most difficult for most traders out there as well, to say, you know what? Maybe my initial analysis was flawed. The level that I identified to initiate the wheel wasn't quite the right one. Something has changed with the earnings or the fundamentals or the technicals for this stock. And as a result, my outlook has changed. So I'm going to bite the bullet. I'm going to take the hit. I had the stock put to me at 20. I'm going to sell it at 15. That's kind of a big boy thing to do, but it's also probably the most difficult. Dan, what are your thoughts on that? Scenario 2, getting the heck out of Dodge.
Yeah, I mean, look, man, there's nothing wrong with that. If that's the only trade you make in your life, oh crap, you're 100% loser. It really sucks. I lost $500 times a couple contracts. Wah, wah. But if you make thousands of trades in your life, then doing that every once in a while, biting that bullet every once in a while is a very, very smart, strategic thing to do, albeit difficult, but smart and strategic.
Our chat's loving it, Dan. They're saying it's a very timely episode. A lot of them are in various stages of this right now. Everyone's got a put that they've sold or a wheel that they've initiated that maybe hasn't worked out exactly the way they planned. I see suggestions here I saw one going by for SMR. They're feeling this in SMR right now. I know I'm personally trading in and around Mara right now. It's a fun one, but an interesting one out there. Very much on the lower end of the wheel spectrum right now, so it makes it kind of fun. They're also debating quality mojitos, Dan. So there we go. We've created quite the mixology and options debate out here. So yeah, scenario 2. You can just cut bait, get the heck out of Dodge, listeners. It's a hard thing to do. I know psychologically and profit and loss wise, it's probably the most difficult scenario here, but that is one way to do it. Scenario, I'm going to call this It could be 3. I'm going to call it 2A, Dan, because it's kind of related to what we were just talking about with 2, which is bailing on the stock. Another way you could go about this is on the way down, maybe all of a sudden you start drifting south of that 20 strike, and now you get down to, let's say, 18, and you realize, okay, you know what? I got in this to sell the wheel. I still want to get some income. I'm okay if the stock gets called away below my price that I had it put to me, so I will take a bit of a hit on it, but I want to offset some of that with some premium. Then you could turn around and sell a covered call against that stock with the full knowledge that you are below your break even in the strike. And again, that's where a lot of people have the psychological impediment. They will only sell that covered call at the 20 strike where they got back in because that's their break even on the stock. They won't sell an 18 call, even if it's trading for a substantial premium, because they'll say, you know what, even with that call premium, I'm still losing money on this trade if I get called away. And also, there's another psychological component to this too, that you got into this because you had some sort of bullish outlook on the stock in the near term, and clipping all that to the upside sometimes is difficult for people. So, in our example, this is a worst case example, but stock, you sold the 20 put, you get it put to you at 20, the stock keeps selling off, and now you're down to 15. In this example, you're going to be aggressive, you're going to bite the bullet, you're going to sell the 15 call, which is an at-the-money call, which is tantamount to effectively saying you're okay getting out of the stock at that level. But you're getting a little bit of an extra. Obviously, you're not just selling it for 15, you're selling it for 15, plus the covered call premium out there. So, Dan, that's why I lump this in as a 2A as opposed to a standalone thing. Because for some people, it's just psychologically difficult to sell that covered call. And also, it has to come with the realization that there's a good chance, unless you really want to roll or do something else, that you might have your stock called away. Dan, what are your thoughts on this version, scenario 2A, where you're selling covered calls at strikes that are below your entry level, sir?
Yeah, I mean, psychologically, that can be hard to do, but try and get over it, because it can be a very, very strategic thing to do. Because, I mean, look, if and when you're in this situation, I mean, I love, hey, if I got assigned at the 20 strike, now it's at 15. I love to be able to just sell the 20 strike. But in this situation, you wouldn't be able to do that. It's 25% away from the money. You'd have to go out a year to get enough premium to make that make sense. But I mean, whatever you sold the 20 put for, plus whatever you sell, maybe like, I mean, the way I like to do is maybe the 16 or 17 call for. Then if you skate on the call, then you already skated on 2 premiums. Like that starts making up whatever you might negative scalp it for in the future. And I mean, you're going to, like, if you trade enough wheel trades, you're going to negative scalp stock on assignment now and then. It just happens. It's statistically impossible for you to not do it if you trade hundreds and thousands of these like I do. So yeah, I mean, it can be very, very strategic to sell the covered calls. But you have to think about it as just a brand new trade. The market doesn't know or care what price you got assigned. The market knows and cares, even though it's not a person, the market knows and cares what the market is right now. So selling a call that makes sense right now with complete disregard to where you got assigned, that's the way to try and wrap your brain around it.
The market's not a person. I've all these years I've been calling him Ted. He's been my buddy, Dan. But apparently that's an insane person would do such a thing. Good old Ted, turn it against me yet again. Curse you, Ted. Again, as Dan points out, there is a possibility here that, you don't get called away, and it does add a little bit of an income stream to a trade that has gone against you. And also, again, psychologically, it is important, as Dan points out. Everyone has that break even in the back of their mind. I entered here. I want to exit somewhere around there. But in reality, your new trade is a new trade. And Ted don't care where you got in, right, Dan? All Ted cares about is what's going on right now, what he can do to you now. So stick it to Ted. Sell a call in his face. There you go. Live to fight. Live to fight another day. At least I crack myself up, Dan. And I can see every now and then I tickle your funny bone as well. All right, let's keep rolling. Scenario 3, Dan. So you had the stock put to you. The stock has dropped now. And that same thing, you sold XYZ, sold the put at 20 strike. You got to put to you at 20. Obviously, your break even is not exactly 20. You have the put premium. But let's just keep things theoretically easy. Your break even's around 20. You get assigned. The stock now drops to $15. What can you do? Now maybe you look at it. Maybe some of your outlook on this underlying has changed. Maybe some things have changed. Maybe all of a sudden they got a new CEO and you like what they're doing, or whatever the case may be. The stock has taken a hit. There's been some turmoil, but maybe now you like it. And in fact, you liked it at 20. You got to love it at 15. That's the old adage, right? So in that case, you can turn around and do the average down trade, effectively initiating a new or a second wheel, if you like to put it. In our scenario here, you decide 15, you know what? I don't mind this level, and I don't mind adding some more underlying at this price. So you sell an at-the-money put, the 15 strike in our example. Let's just leave the premiums out of it for now. You sell the at-the-money put for whatever you get. Now, if you're assigned, guess what? Your new break-even price is effectively right between those two strikes, right? 17.5 minus, of course, whatever put premium you got for that 15 put. So you can see right away why that's attractive. You bought some at 20. Now your average price in that position is $17.5. So that's definitely attractive. You've lowered your cost basis on the trade. If you're not assigned, same thing as the covered call. You're skating. You're keeping some of that premium. That all goes back into the machine. You feed Ted for another week or another month, and you offset some of your losses. So that's also attractive. The con is also obvious. You're now kind of doubling down on this trade, or whatever size you do the second leg on. So you're tying up a lot more capital in a trade that has already gone against you. So there could be some issues with that as well. You have to be careful at the end of the day. You're not just throwing good money after bad, doubling down on a trade that already is not working out and just chasing losses. So again, this gets into the psychological underpinnings of some of these trades, and whether or not you actually really want to do this, or you're in the back of your mind, you're still chasing that $20 entry point, and all of your trades after that are kind of geared around that, which is a very skewed perspective. So Dan, what are your thoughts on this? The stock drops, in this case, to the 15 handle, and you decide you like it more. And so you decide to initiate, I guess you can call it wheel 2.0, and sell some more puts on that 15 strike with the intention of averaging down, sir.
Yeah, so the wheel's an interesting strategy because it's trading options, but a lot of times it's also investing. And so when we're trading options, when the market goes against us and we just double down on our position, we call that catching a falling knife. That's what traders are not supposed to do. But investors, what we call that is average pricing. We call that being smart. So it's the same action. You're selling the same put, pushing the same button in the same account. But am I a trader on this trade, or am I an investor on this trade? If I am an investor and I wanted to get assigned because I liked the valuation of that stock at that price, it's just, oh, this kind of stinks that it's down so much and I have a short-term loss, then by all means, man, sell Mortimer, sell more puts, palms out. But if you were just trying to skate and you're like, oh crap, this sucks, then that's catching a falling knife, and you should probably avoid it.
All right, another option, listener, scenario 4. Again, same thing. You sold the put, you entered, drops to 15. What do you do now? Another way you can go about it, something we discussed recently on our pro content on Options Oddities, which is you can turn around and put something else on against it. Again, take that step to lower your overall break even on this trade from a stock perspective, but this time without adding risk and without adding cost. What are we talking about here? This is the old stock repair trade. We talked about this a few times here, but you can do this in a variety of different scenarios, including attaching this on to the wheel trade after it goes against you. So in this example, obviously, stock has sold off from 20 to 15. You're kind of wearing it now. You have a bunch of different options. We've just gone through a few of them. Again, maybe you are a little bit bullish in the near term on this stock. You do think it can still turn around, but not enough to commit more capital to it, to double down like we just talked about selling puts. But you think if it can get back to around that, 17 to 18 range, You think that's probably the most you can expect from this name in the near term, and you'd be okay getting out of that level. Well, guess what? Sounds like you have an ideal setup here for a stock repair. So now instead of selling that 15 put or selling that covered call on the 15 strike, you're going to buy the 15 strike call in our scenario, turn around and sell 2 of the 17 half calls in our scenario. Now, in our scenario, everything works out perfectly and it costs you no money. In reality, could probably cost you a few cents. Maybe you get a credit if you're lucky, depending on the way you structure it. But in reality, you're probably going to have to shell out a little bit. The ideal thing with these stock repairs is to shell out as little as possible. That's one of the nice things about them, is they don't cost you much or really anything to add on and to improve the overall risk profile of your trade. And now if let's say you get that off, you buy the 15, 17 half, 1x2 call spread for effectively even money. What do you have now? You have a long stock leg, you have a long 15 call, your short 2 17 half calls. So you can think intuitively in the back of your mind, what happens if the stock rallies? Guess what? You're getting called away at 17 half now. So what you've done is something that is effective to what we just talked about earlier with the averaging down. You've gotten that break-even price lower to $17.50, but you haven't shelled out more capital, or maybe if you have for this trade, very nominal capital. And you haven't really increased your risk at all. And if now you get up to 17, you've made money on the stock leg, you've made money on the call vertical, and you get out, live to fight another day at $17.50. So the pros for this are pretty obvious. You've reduced your basis without really spending any money or adding to your risk. The downside of this is, ironically, the upside. The downside is maybe you got a little bit overzealous in your concern, and it was just a blip in the stock, and now, bam, the stock rallies back to 20, and guess what? You're out at 17.50. So that is one of the risks you face with this type of trade. Dan, what are your thoughts on legging into a ratio vertical stock repair against a wheel trade, sir?
I like it under the right circumstance. The stock repair strategy, I don't use it a lot. I use it pretty sparingly, but the times when it's the best thing to do, oh man, I mean, it is just a godsend. I mean, it's just such a strategically great trade. So yeah, under the right circumstances, for sure. And, I mean, this might be one of the ones where under the right circumstances, like, I mean, you probably wanted to skate, but you didn't skate. Now you're stuck with the darn stock, but you look at what the market is right now for that, do a new evaluation. It's solidly bouncing off support, or it's fundamentally like way underpriced. Then yeah, I love it, man. I just freaking love it.
I did execute one of these recently against that wheel I was telling you about in Mara, so it's been kind of fun to watch that one play out, something we've been talking about a lot on our options oddities of late. So Dan, that's just 4 very common scenarios, very common ways you could deal with a wheel that has gone against you. I want to make sure we get going into our next show for our quintuple palooza today. But before we do that, Dan, you are indeed working on a book on the wheel right now. I may or may not have seen an early copy, listeners. Hint, hint. But that said, do you have any other adjustments or scenarios you want to lay out with the listeners about when the wheel goes bad, sir, and what you do?
Oh my gosh. I mean, yeah, but it's hours when we don't have hours. So
you have 3 minutes. Go.
Maybe we can just plan a sequel episode with a call example instead of a put example.
We can do all those things. There are infinite ways to play with the wheel, so chances are we will come back around this way soon. All right, Dan, that music means we have to keep rolling on to episode 2 of our boot camp doubleheader and our Insider Pro Quintuple Mania Day because the producers hate me, Dan. But I may or may not have dug this hole myself, so it's all right. I won't blame them today. But that said, Mr. Dan, if folks have questions about the wheel, I got a feeling they might after a show like today. Where should they go? What should they do?
Head on over to my Substack. I write weekly articles for our subscribers there, and you get lots and lots of great stuff. It's just, if you're over on Substack, you can probably look up my name, Dan Passarelli, or you could look up Wealth Building with Options. Wealth Building with Options, and I'm there. And then you get all the stuff I'm talking about,
including a lot of wheel stuff over there these days, listeners. And if you want to check out some stuff online, make sure you're checking out our friends over there at Tasty Trade. TastyTrade.com/podcast, place to go to see what deals they've got in store for you, the beloved Bootcamp listener. That is going to do it for us on OBC. Back again, though. If you're listening live, and yet another reason why you should be joining us in the Pro, we're back again with episode 2 coming hot in your ear holes right now. Otherwise, we'll see you back here next week. Another episode of OBC. Stay safe out there, everybody.
Old trading walks into a bar. New trading raises it. That's Tasty Trade. Keep focused with news feeds that matter. See opportunity differently in analysis mode. Chart your heart out with over 300 indicators. Plus, you can get low pricing, lots of education, and a support team that really gets how traders trade. It's no wonder Investopedia named Tasty Trade the best broker for options in 2024. Genius loves company. Go to tastytrade.com/podcasts and see for yourself. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.